This is Bloomberg Businessweek. Insight from the reporters and editors who bring you America's most trusted business magazine, plus global business, finance, and tech news. The Bloomberg Businessweek podcast with Massar and Tim Stenovec from Bloomberg Radio.
Geopolitics always on our mind here at Bloomberg. Negotiations advancing for an agreement to pause the Israel-Hamas war and free civilian hostages captured by Hamas, that according to people familiar with the matter, in a deal that those involved believe could be a crucial step toward ending the 4-month conflict. So watching that, but we're also watching other stuff.
Yeah, we're keeping an eye on the war between Ukraine and Russia, Russia's invasion of Ukraine. European Union leaders struck a deal on a $54 billion financial aid package for Ukraine. Carol, the moment is crucial for the country, which has warned that its coffers are emptying as it grapples with a shortage of weapons to fend off the Russian military campaign. Kyiv is still waiting on $61 billion in assistance from the U.S., yet to be backed by Congress.
All right, so we want to talk about that. We also wanted to talk about how Russia is in a new push to expand its influence in Africa. So a lot to get to. Back here on Business Week is Angela Stent, senior fellow at Brookings, author of Putin's World, Russia Against the West and With the Rest. She's a former national intelligence officer for Russia and Eurasia at the National Intelligence Council, also served in the Office of Policy Planning at the U.S. State Department. She's a great voice on this, and she joins us once again on Zoom from Washington, D.C. Angela, great to have you here. Hard to believe we were on almost year 3 of the war between Russia and Ukraine. Talk to us about where we are today and what you see maybe as the way forward, for better or for worse.
Yeah, well, where we are, this is still a very grueling, grinding war of attrition. The Russians have made some territorial gains in the past couple of months, and they seem to be still on the offensive. The Ukrainians, of course, their counteroffensive last year didn't go the way they'd hoped it would, and they are very much on the defensive now. As you said, that their problem is they're running out of ammunition, they're running out of soldiers, and they're running out of money. It's very good that the European Union finally got round Viktor Orban's veto, and they voted the 50 billion euros for them. But things don't look great in terms of our own Congress. Even if the Senate gets a bill done and passed, the House looks like it won't agree to it. And that would really make it very difficult for Ukraine in 2024, because we are the ones that supplied them with the most advanced weapons.
Let's talk a little bit. Yeah, I want to talk a little bit about that, Angela. How crucial is that $61 billion that Ukraine is awaiting on from the U.S.? How critical is that to Ukraine's fight?
I mean, it's critical. At least they've got the money from the Europeans, but they need they need the money. It's to keep the government going, to purchase the arms and the ammunition and everything that they need, to keep the economy from tanking. So again, if they don't get that U.S. aid, things are going to be very, very difficult as the year goes on.
Hey, Angela, one of the things we love is your depth of knowledge when it comes to Russian President Vladimir Putin. I'm thinking, if you were advising U.S. officials and their allies, what's the security kind of elevator pitch, if you will, at this point in this war, that all of those folks, the U.S. and their allies, have to keep in mind if Vladimir Putin ultimately wins or gains ground in Ukraine here? I mean, they already have, but in this go-round, if you will.
No. I mean, I think the elevator pitch is, if the Russians defeat the Ukrainians, which they might if the Ukrainians don't get what they need to continue the war, then this represents a massive security threat to Europe. They might stop at Ukraine for a while, but as long as Putin or someone like him is in the Kremlin, they want to continue taking back what they believe is theirs, the former Soviet states. You have the Baltic republics. They've even talked about Poland and restoring the Russian Empire, which of course included part of Poland. So it is a security risk. And the other part of it is, what will the rest of our allies think? The Taiwanese, all of our other allies, if we don't supply Ukraine with what we've promised them, doesn't look good for the U.S. around the world if that happens.
So it raises the question of what happens here in the United States in November, Angela. How are you watching politics play out between now and then, and ultimately who wins in November?
Well, I'm watching it very carefully. I think we have a pretty good idea of what Donald Trump would do were he elected president. In this, he wouldn't support the Ukrainians, and he'd make a deal, some kind of a deal with the Russians. We can talk about whether he'd try and pull the U.S. out of NATO as well. He tried to do it last time. So I'm watching that very carefully. If President Biden were to win, then I think we would have a continuation of these policies. But I think we would still need, going forward, a kind of even more robust U.S. and allied response to what Russia's doing to make sure that they don't defeat Ukraine.
Yeah, I feel like there's a fair amount of critics on both sides of the political aisle, depending on or either who wins come November, because I think there's a lot of folks who are talking about this being existential threats around the world, and that the U.S. plays a role no matter who is in the White House, and they kind of need to step up. Having said that, one of the reasons we really wanted to bring you on initially was a story that came across the Bloomberg by our Bloomberg team about what Russia is doing, its new push to expand its influence specifically in Africa and recruiting for its own army there to replace the Wagner Group's mercenaries across the continent. We have all talked about the Wagner Group a lot over the last couple of years. Of course, its group's former chief, Yevgeny Prigozhin, died last year in what some would say was maybe a suspicious death. But having said that, what does Russia want ultimately as maybe it goes for more as it expands its presence perhaps in Africa?
Well, it certainly it would love to recoup the influence that the Soviet Union had in Africa, which was really quite considerable. And then, of course, Russia withdrew after the Soviet collapse. It's to recoup that. It's now backing a number of, or Wagner was backing, and I guess the Russian army, the new Africa Corps, ironic, since that was what Hitler called his troops who fought in Africa. But this new Africa Corps will support these Russia-friendly governments, particularly in the Sahel. They're military dictators, they're authoritarian leaders, and they have lots and lots of resources. Wagner made an enormous amount of money out of these mining resources, gold, diamonds, other things. So the Kremlin needs that. It'll take that money and help it fund the war in Ukraine, and it will expand its influence. As a number of these countries, they're suspicious of the West. The French have withdrawn, like from a place like Mali, and what the Russians are offering these leaders too is that they will support them in their fight against insurgent groups. They give them intelligence support, military support. So this is really Russia's back to Africa.
So what would you say you'd suggest to policymakers about the way they need to be watching what Putin does, what Russia does around the continent of Africa?
Well, I think, first of all, we, the U.S. and our allies, we need to make sure that we still have a presence in Africa. I mean, Secretary Blinken has been there fairly recently. So we're watching for the Russians apparently want to build a military base in the Central African Republic, watching what the neighbors of some of these countries do, because I think the Russians are there to stay. And from the African point of view, and I've heard this from Africans, they see Russia really as a balancer against China, and they don't want China to dominate the continent.
You know, Angela, I know we've talked about this a lot here, and I think about sometimes there's folks here who are listening or watching. We have a smart audience, but I think sometimes they're like, well, that's far away. It's more of Europe's problems. But it's not, ultimately. It's the world's problems in terms of what Russia does ultimately and Vladimir Putin does.
Yes, it's certainly. I mean, we are in this, era of great power competition, which some people thought had gone away, but obviously didn't. And yeah, the more that Russia can expand its influence and get the loyalty from these countries and take their resources, the more they challenge us, and it makes it harder for us and our allies to maintain the kind of, international rules-based order that we would like to maintain.
Angela, you know that whenever you come on, we get an update on what's happening between Russia and Ukraine. I always ask you the same question at the end. How does this war end? Here we are almost 3 years into it. How do you think it ends now?
Still very difficult to say. If the Ukrainians don't get what they need to continue this war, then they may have to make a deal with the Russians that involves territorial concessions. That's one scenario. It's very hard to imagine a scenario where Vladimir Putin says, okay, I've done enough. It's time to end this. No sign that that's happening. So I'm afraid that as we go into the third year of the war, there's very little sense of how this is going to end.
Does it end this year? Real quickly.
No, I don't think so.
All right, going to leave it there. Listen, so appreciate it. Once again, Angela Stent, Senior Fellow at the Brookings Institution. Her book, Putin's World, Russia Against the West and With the Rest. And I know we've kind of kidded her, I think, in times past about, are you working on a new book? And maybe what you would call it. So looking forward to see what she may put forth in the future.
Oh, we got to stop calling on her to come on the show so she could work on something.
This is true. This is true.
You're listening to the Bloomberg Businessweek podcast. Catch us live weekday afternoons from 2 to 5 p.m. Eastern. Listen on Apple CarPlay and Android Auto with the Bloomberg Business app. Or watch us live on YouTube.
Well, we just finished up January, and even after yesterday's sell-off, both the S&P 500 and NASDAQ 100 were up by more than 1.5% for the month overall. Bitcoin, too. We've been watching this pretty closely.
Yeah, ended the month flat after coming back to earth from that spot ETF frenzy earlier in the month. So we wanted to check in on how retail investors are feeling about all this. What's their sentiment right now? So we've got the perfect guest. Lule Demisay is U.S. CEO of the retail investing platform eToro. She joins us on Zoom from Hoboken, New Jersey. Lule, good to have you back with us. You joined eToro back in 2021. We've spoken to you a few times since then. That was the height of the pandemic-driven retail investing boom. Talk to us about what you're seeing on the platform right now compared to what you were seeing back then.
Yeah, I mean, definitely the froth of what's back then sort of has definitely left us. And at that point, what hindsight taught me was that I thought the retail investor was going to be scared off with, a bubble bursting, high interest rates, inflation around the bend. And what's really been interesting in these last 2+ years that we've seen is the resiliency of that investor. They started off at the peak of 65% of households and are keeping it around 63% now, and leaning into a lot of what you would think are risk-on investments in this environment.
Hey, help me out there. And maybe I just need another cup of coffee. But those percentages, what does that represent, if you would?
Percentage of U.S. households, individual households that are participating in the retail sort of investing markets right now. So at its peak, it was about 65%.
Right.
During the COVID era, and it's persisted in the mid-60s till even now.
Talk to us.
That's so high. That seems so high to me.
Well, talk to us about the demographics. I'm always interested when you've got a big number, but you dig down into the data set. So who exactly is making up that percentage base?
So in terms of the percentage base, it could be households that are, ultimately that are partaking through their 401k, through their IRAs, through a brokerage account. But ultimately what we do is also to break that down. We do a survey every quarter on retail investors. And what you find in that retail investor base is, for example, when I said risk on, more than 57% are participating in AI related stocks. Retail investors, some way or fashion of AI related stocks. Similar to crypto, about 20% of their portfolio is made up of crypto. The
20%?
Younger you go, the more. Yeah. The younger you go, the higher you see that percentage. So the younger you go, obviously, time is on your side, and so you're able to take on risk on. What's interesting is they're doing it even now in this environment. And it's not that dissimilar to what we're seeing in the marketplace right now.
I do wonder if it's also, a younger generation. I mean, Matt Miller's side. Oh, not that you're not young, Matt, but Matt Miller's side, like using ChatGPT and be like, I get it. Like, this is kind of fun. And so I always think of Peter Lynch way back when, a Fidelity, thought about how, kids, you understand something, invest in the things that you understand. And I wonder if that's what's going on, essentially.
Yeah, you took me back to the Magellan Fund. Yeah, no, for sure. What's interesting is, when we had the '08 crash, the younger generation actually left the marketplace.
Right.
They were scared for 10 years. And they came back really when investing became more prolific through mobile apps and other things. This time around, they stuck around. But you're absolutely right. They lean into technology. So whether that is that high percentage of AI investment that I told you about, crypto, or leaning into AI as a mechanism to inform their investment thesis, you see that more and more with the younger generation.
Hey, Lule, what I wonder too, though, in terms of demographics, digging even a little bit deeper, about the people using your platform predominantly. Who are they? What are they? Give us some details if you can.
Yeah, so they look very much like the people we survey on a quarterly basis. So our platform, over 55 to 60% of it is millennial or younger. And then the tail ends are really sort of like Xers. So we represent what I call like tomorrow's investor today. So our investors look very much like the people we survey. And more women are participating as well. When you look at the demographic shift, you see year over year, more women are taking on AI themed investments than there are men.
Can you talk a little bit about that? I mean, we'll get to the AI part of it in a second, but do you see women participating more overall on the platform now than they have in recent years, AI notwithstanding?
Absolutely. Whether that's the kind of investments they hold, whether it's crypto or AI or stocks or technology stocks.
What's the gender breakdown?
So overall, typically in America, what you find is that in just regular stocks, women and men have become sort of like a 50-50 parallel, right? But when you go into like a little bit more complicated investment strategy,
we're having some technical difficulties with Lule Demasay right now, the CEO of eToro US. But we're going to get back to her in just a minute. I do have some stats here, which I think are really interesting because they did this quarterly survey at eToro. It's called the Retail Investor Beat. It measures investor sentiment, activity, perceived risks to portfolio, and more. And what they found is that 65% of younger investors, those are 18 to 34 years old, have exposure to AI stocks. It's the highest among all age groups surveyed.
Yeah, so 58% for 35 to 44-year-olds, 37% for 45 to 54-year-olds, and about 9% for investors aged over 55.
All right, let's get back to Lule Demasay, the U.S. CEO of the retail investing platform eToro.
AI is going to fix that, Lule. Yeah. We know that in the future. We're banking on it.
But you were telling us about
never change your Wi-Fi provider before you do a Bloomberg
deal. Yeah.
Hey, you were talking about the gender differences that you're seeing right now. You said it was half and half when it comes to overall stocks, but then you got cut off when you were talking about different types of stocks.
No, like the more complicated strategies where you see more retail participation, like options, for example, is a good one, right? You actually see more participation now in options than you did even during the pandemic era, which is kind of like counterintuitive. Women are still underpenetrated in those kinds of things. But when it comes to technology, they're going toe-to-toe with their counterparts, especially when they go younger women. Younger women are starting to close that gap faster than maybe sort of like, Gen Z, the Gen X and older generation.
Is there anything in terms of the trends that you are seeing on your platform specifically that gives some kind of indication of maybe an overheated market? We've had quite a run-up, bounce back from the lows in October. Some would say we're just still kind of catching up ground over the last couple of years. But having said that,
would say potentially irrational exuberance.
Exactly. So is there anything that you see when I hear like you're doing surveys and it's all about everybody kind of channeling money into AI? The big mega cap tech companies this week have been disappointing on the AI front. We'll see what we get today after the close. But what does it tell you about kind of the macro investment environment? Overheated, irrational exuberance, or no?
I think that it's too early to say irrational exuberance. We're still coming out of a winter on so many levels. And there's a lot of diesel in whether it's lower interest rates, that's the potential, or a soft landing, that I think it would be too premature to be talking about overheating. And what you do see on our platform, by the way, is people still partake in cash, for example. They keep powder dry. When they tell us what they're about to invest in, they say a good part of it is going to be holding powder dry in cash because they're not stupid. They're getting their interest rate as well. So I would say it's not so much irrational exuberance as you see more people realizing that technology over and over again, outside of like some of the bubbles that burst, keeps outperforming other sectors. Whether that's technology,
we only have like 30 seconds left, but I want to know about that dry powder and at what interest rate you think it'll go back into the market and where it goes. Does it go to fixed income or does it go to equities?
For a lot of the generation that we have, it's a lot of cash, right? Because why would you go into a more complicated instrument when risk-free investments are giving you 4 to 5% interest? So a lot of them are holding it in cash with high interest rates that are available to them. So I don't think that that's necessarily going to change as much as perhaps interest rates going down and then deciding that they're going to go higher risk.
Right. Well, we talk about that kind of record, $6 trillion
money market,
sitting on the sidelines in essentially cash, right? And everybody keeps saying when they come back to the markets, what kind of momentum that would provide, provided they come back to the markets and investors are willing to take on a little bit more risk. Lule, so glad that we got to get some time with you on this Thursday. Lule Demasay, she is U.S. CEO of the retail investing platform eToro, joining us on Zoom from Hoboken, New Jersey.
This is Bloomberg Businessweek, insight from the reporters and editors who bring you America's most trusted business magazine, plus global business, finance, and tech news as it happens. Bloomberg Businessweek with Carol Massar and Tim Stenovec on Bloomberg Radio.
I'm just going to say, whoa, what a difference 24 hours makes, or 48 hours. Because again, just to rehash as we did on our way out with our TV colleagues, you've got Meta up almost 9% here, Amazon up about 4% in the aftermarket. Very different, as we were breaking earlier in the week, Microsoft and Alphabet, right? It was just very, very different.
Yeah, Meta boosting its buyback by $50 billion.
Massive.
Sees first quarter revenue between $34.5 to $37 billion. The estimate was for $33.64. Paying a quarterly dividend of 50 cents per share, so returning money to shareholders. Carol, it's pretty remarkable to see. I want to get to James Chalkmark. He is a partner and technology analyst at Clockwise Capital. Look, we have Amazon results, we have Meta results, we're getting Apple later. James, this is a pretty blowout quarter for Meta Platforms. That's where I want to start. What sticks out to you?
What is that the cost advantages that we saw over the last year that they've been implementing are more sustainable than people expected. Obviously, the top line is firing on all cylinders, really not seeing any kind of cyclical impact to that business as of yet. But all told, the earnings picture looks a lot stronger, and I think you're going to continue to see productivity improvements operationally to boost earnings as we go forward.
All right, flip on over to Amazon. We're just doing a quick touch first initially on these two. Amazon's up about 3.3% in the aftermarket as well. What is it that kind of impresses you about their release here?
Yeah, I mean, the main thing is on the improvements in the margins. I mean, this is something that they've been working on for the last year, really getting logistical efficiencies and optimizations and leveraging the AI to add predictive supply to different regional fulfillment centers. So that's all playing out. The one question that we had going into this quarter was how much of that bore fruit in the fourth quarter, because it's their kind of first big holiday quarter with the optimizations in place. So we were unsure about that, but more so optimistic on the go-forward outlook. But I think you're going to continue to see momentum. I mean, this is a company that's, over 50% of every new dollar that goes online, they capture.
Wow.
They have all these new levers with, advertising. Now they're the third largest ad platform in the world. And, a lot of these things aren't talked about. The revenue that's going to flow through on the ads that are placed in Prime Video are just going to trickle down to the bottom line. So you have so many levers in this company. You really want to look at it more on a sum of the parts basis, obviously, but the street doesn't do that. On a sum of the parts basis, AWS by itself is over $1 trillion.
We want to go back. No, go ahead, please.
Yeah. No, I mean, so basically, this is a company that we think has a tremendous amount of optionality potential to it. So the way we invest is how predictable is the revenue and margin outlook, and how much optionality is priced in or not priced in.
I know.
So based off of that, Amazon's right up there.
I know all of these, we lump all of these mega cap tech companies often together, but they're not apples to apples.
Sure.
I get it. But it just seems such a different tone here, watching how the shares have reacted right after earnings, and you've got Meta and Amazon shares soaring. Yet I go back to Microsoft and Alphabet earlier in the week. What's the difference? And again, not apples to apples, but I'm curious how you are thinking about this sector overall and these names.
Yeah, the so-called Mag 7, we kind of view it as just three companies now. It's Microsoft, it's Amazon, and it's Meta. The other ones, we are overweight those names and underweight the other four. Because at the end of the day, it comes back to the predictability and the optionality. Now, Microsoft, I think, was just a bad luck with a bad tape. With Powell certainly didn't help yesterday. So I think that wasn't a warranted kind of reaction. It should have been flat to slightly up. But Google, they're a mature company. You're not seeing the growth levers as strongly as the other three.
Hey, James, to Meta Platforms briefly. Is Meta Platforms still a metaverse company, or has Mark Zuckerberg decided, okay, we wasted enough money on the metaverse and we're investing in AI in our core product?
Yeah, I think it is. I think the world is moving in that direction. As I'm optimistic about it as an investor.
The metaverse?
I'm slightly worried about it.
You-
As an investor, I'm optimistic about it, but as a constituent and citizen, I'm nervous about it.
The metaverse, that is, right? I just want to make sure we're talking about
Yes,
the
the
same thing.
metaverse.
Okay.
Yeah, living in a virtual world, never meeting people again, basically.
Yeah, I would miss you if that happened. But you're not concerned about it as an investor. You think that the money they're spending on the metaverse is the right direction.
Yeah, as long as it's a predictable value. If we have, they increase their investments by 10x out of the blue, obviously that throws a wrench in our assumptions. But as long as they're investing steadily and in a measured way, I think it's improbable that the world does not go in that direction, and they're at the forefront of it. Obviously, it's going to take time, but who better to be ready for it than Meta.
Hey, listen, I got to mention, because this is just crossing too with earnings, Microchip Technology, of course, a semiconductor device company. And this one is dropping in the aftermarket. It is down about, let me just bring it up here for everybody, down about 3% here. And this is what the company is saying. First of all, it sees fourth quarter adjusted EPS 46 to 68 cents a share. You could drive several trucks through that. The estimate on the street is way above that 92 cents. It says it's going to have 2-week shutdowns in fabs in the next 2 quarters. So we talk about cycles. So it sounds like some shutdowns there. Fourth quarter net sales, $1.23 billion to $1.43 billion. That too is quite a range. The estimate on the street is above that at $1.67 billion. I just wonder if you have some thoughts on the chip sector, which we keep, it feels like it's piling on some of the negative tone here.
Sure. I mean, our top ideas right now are NVIDIA and Supermicro.
Supermicro's been on a fire for several years.
I mean, we bought that at 283, so I can't complain. The fact of the matter is we kind of look at this AI and this whole semi market in 3 buckets. Bucket number 1, which is the most near term and the most resilient and robust growth, is going to be AI infrastructure, building out the data centers, the servers, and all the components that go into it. All the CapEx that we talked about, all the fears with Google, Amazon, Microsoft spending on CapEx, these are the companies that are supplying that. So that's what the second tier is, the companies that help you design the chips and adapt those chips to AI, like a Synopsys. And then the third tier would be the software, AI-based software services like a Snowflake. So we're leaning heavily into the AI infrastructure side of things, and we think that the other part of the semi market and AI software market will be more of a 25 story.
All right.
Hey, go ahead.
Well, I was going to say, do not go anywhere.
I was just going to give an update. I mean, Meta Platforms up 12.5% in after hours right now. Still waiting on the call here from Mark Zuckerberg and other executives. Shares of Amazon right now up by 3.8%, and we're still waiting Apple to report.
I got to say, on Meta, I'm looking at our live blog that's breaking it down. Kurt Wagner, who follows a tech reporter, he says, how efficient was the year of efficiency for Meta? He says headcount was 67,317 as of December 31st, a decrease of 22% year over year.
That's a pretty good way to get earnings up.
Bringing it down. And that buyback, additional buyback authorization of $50 billion, and then also tossing investors a dividend. That is pretty remarkable. Not that, what?
There's also some news about the actual metaverse in this.
Exactly.
Very deep in this, Carol.
Go to it.
The company is going to continue to lose money in Reality Labs. It's the division that makes the metaverse technology. But here's a bright spot for Zuckerberg, as our own Aisha Counts points out on our live blog. His VR ambitions, that is, quarterly revenue in Reality Labs crossed $1 billion for the first time.
Yeah, so maybe it's starting to contribute.
It's an incredible quarter for the company.
All right, let's get to it. James Chalkmock sitting by, partner and technology analyst at Clockwise Capital. We've also been talking about Amazon, which is also up about 4 or 5% here in the aftermarket. It reported strong profit, gave an operating income outlook that surpassed estimates. Again, talking about, Charlie mentioned this, CEO Andy Jassy's unrelenting cost cutting and focus on services that make money is reshaping the once free spending company. Yeah, it's a little bit different perhaps under Andy Jassy, but nonetheless, James Chalkmock, we're waiting for Apple. you've had a little bit more time to think about these results. Go back to Meta. It's been on a tear for a while. As we said earlier, I mean, it's doing better than Apple has been and Amazon this year. What is it about that Meta story that you think all of a sudden their focus is right now?
Yeah, first I say with all these dividends and buybacks, it's like these tech companies are becoming the new Dow component. As far as Meta is concerned, I think one of the best things that could have happened to them was the Apple's privacy changes, because that absolutely destroyed them. Where in the sense that they could not target users in the way that they used to, and Apple obviously preferred their targeting capabilities over third parties. So. But what that enabled them to do was actually come out stronger on the other side of it, where they retooled everything and improved targeting capabilities and essentially increased the span of the walled garden that they have, and in that process, I think has increased their competitive positioning versus smaller scale ad companies that couldn't adapt fast enough or didn't have the resources to adapt. So I think it just made them stronger at the end of the day. And I think as we look forward, it's going to be very difficult for them to be derailed as far as the top line is concerned. And when we think about the overall value of the company, I think it's conceivable that next year we could be looking at $20 in earnings, and at a 25 multiple, that puts you at $500. And potentially there's upside to those numbers here. And that's when it comes back to what is the base case? What is the optionality? Base case, I get 500.
You mentioned, James, other smaller companies. Snap is a company you followed for years. It's been under pressure lately, but it is up 6% in the after hours in sympathy with Meta Platforms. What do Meta shares tell us about what Snap could report?
Yeah, I just don't really care for Snap anymore. I think they haven't found their niche in the manner in which I originally thought that they would. For smaller tier players, I like a Pinterest, for example. I think they really have their DNA set on the inspirational social feeds and increasing their presence on the commerce side of the equation. So I'm looking at more companies like that. Now, we sold out of Pinterest because it got ahead of our valuation targets, but it's companies like that I think can still have a place, but at the end of the day, it's still going to be the Googles and the Metas of the world.
Well, speaking of that, so as we've been talking about Meta, just on a tear right now, it's up about 11-12% here in the aftermarket, 13%, forgive me. Amazon's up about 5.5%. Obviously, if you bought it yesterday, it was a better timing call. Yeah. But having said that, and everybody says, don't time the market, don't time names, and so on and so forth. Anything, though, in these reports that would say, you know what, I need to take a look. Maybe it's time to allocate a little bit more to these names specifically.
Well, we're already, we run pretty concentrated, so we're pretty heavy. But I would say at this point, Amazon continues to offer the most upside at 225 is kind of where we're thinking it can go over the next year and a half.
That's about a $65 run from here, yeah.
Yeah, and then Meta obviously we think can get to 500, but I think I would own all three. I mean, at this point, kind of we view a full size weight around this, upwards of 6% of the portfolio. So, we don't mind being at max weight on those and letting them run if they, they go north of that, which they will, after tonight's result. The
ETF that you guys have at the Clockwise Core Equity ETF, I should note, NVIDIA is the top holding at 5.3%, then Spotify, Meta Platforms, Microsoft, Amazon, Apple, rounding it out.
Yeah, so you're all in, no doubt about it. Hey, listen, we're watching Apple in the aftermarket. It is up about 0.6%. In about a minute from now, we assume we will be breaking down those Apple earnings. What are you watching out for most in those results?
Obviously, on the guidance, on the iPhone outlook, I think the quarter is going to be fine, actually. One of the things that I think is underappreciated this quarter is the reversal and reacceleration on the Mac side. I think that could surprise to the upside. The street's expectations are pretty modest at 1% growth. So I think the quarter will be okay. I think the big question is going to be, what is that iPhone device outlook for the year and for the next quarter? But we won't really know that until the CFO's commentary.
Do you think that the China issues are overblown, James, for Apple's iPhone?
Yeah, to some extent. It's hard to say. But we're not relying on massive growth in the iPhone. What we're relying on is no massive deceleration in the iPhone. As long as it's the status quo there, they have other levers okay.
James, hang on, because we've got first quarter numbers coming for Apple, and this is...
It's a beat when it comes to first quarter revenue for Apple. $119.58 billion, beating estimates of $117.97 billion. First quarter revenue for the iPhone coming in above estimates too at $69.7 billion. Estimates were for $68.55. Greater China revenue also missing expectations significantly, $20.82 billion versus estimates of $23.5 billion.
Yeah, maintaining its quarterly dividend at 24 cents a share right now. Apple shares just up about 0.4% here in the aftermarket. We can dig a little bit deeper. iPad revenue $7.02 billion, a little light, but pretty much in line. The estimate was $7.06 billion. First quarter wearables, home and accessories, $11.95 billion. The estimate of the street was a little bit above that at $12.02 billion. Mac revenue $7.78 billion versus the estimate of $7.9 billion. And again, going though to what really matters is the iPhone revenue, as Tim mentioned, $69.7 billion. That was a little bit above the estimate of $68.55 billion. Again, though, we're seeing Apple down about 0.5% here in the aftermarket. Expenses, total operating expenses, $14.48 billion. That's a little bit light. $14.62 is what the street was looking for. And first quarter EPS, $2.18 a share. That was 7 cents better than what the street was expecting. So that's just the initial reaction. And again, as we said, shares of Apple here in the aftermarket, while Meta and Amazon are rallying big time, we've got Apple shares just now down about 1% here, Tim.
James, what do you think about this? We have a minute left with you. You heard us rattle off some numbers there. iPhone coming in above estimates, and then first quarter revenue coming in above estimates, but a pretty big miss when it comes to Greater China revenue. What are your takeaways?
There could be something to be said about the reports coming out that the China market may see greater competition. But again, I want to wait for the call to make that determination. But the biggest standout from the numbers you just cited was Mac was lighter than I expected. I thought that could reaccelerate. iPhone status quo, or I guess better than the street, but largely status quo, so that's fine. And then the wearables and iPad was already expected to be down. So I think this is a wait and see. It could go either way.
Yeah.
But it's a position that we've downsized.
The company's CFO in the press release saying, during the quarter, we generated nearly $40 billion of operating cash flow, returned almost $27 billion to shareholders. We're confident in our future, continue to make significant investments across our business to support our long-term growth plans. James, be quick. 10 seconds. Number one question on the call for you?
The number one question, would likely be, I would talk about the PC upgrade cycle. Their view on, the timing of that, and if this is indeed a 24 event.
All right, really appreciate it. James Chakmak over at Clockwise Capital.
I'm driving in my car. I turn on the radio.
How about you let me drive?
Oh, no.
Who's gonna drive you home?
Honey, please, I'll do the driving.
Drive on.
Excuse me, I want to drive.
It's the question that drives us.
This is the Drive to the Close
That funky music will drive us till the dawn.
on Bloomberg Radio.
All right, everybody, we're just about 17 and a half minutes away from the closing bell on this Thursday. We've got equities. You just heard Charlie breaking it down. We were near our highs of the session. Some buying here in the last 20 minutes or so. We're up more than 1% on both the S&P and the Dow.
Jay Powell was like,
momentum.
didn't you guys hear me yesterday? Did you not hear what I said?
Maybe this is what we were just talking with our Bill Maloney off air, that I felt like he was very clear. He's kind of laid out a path for us, and maybe it's not going to happen in March, but I feel like we're getting, he did say peak in terms of this cycle.
Okay, I'm going to see what Liz Ann Saunders has to say. She's Chief Investment Strategist at Charles Schwab. She joins us on Zoom from Naples, Florida. Liz Ann, always good to chat with you. What do you think of what is going on in the wake of yesterday, what we heard from Fed Chair Jay Powell? Was he clear?
I think he was incredibly clear. And I think, by the way, he was trying to be clear even before the meeting. We were not expecting that March would be the start to cutting, and we're frankly somewhat surprised at how high probabilities stayed even heading into the meeting. But I think he was very clear, and he wasn't just clear by essentially. I mean, it did take till 3:00 Eastern time for him to say essentially a March cut is off the table, but you could infer it prior to that. But he was really clear about what specifically they're looking for. He talked about the aggregate of inflation numbers versus the goods versus services. He talked about the labor market, part of their dual mandate coming into clearer focus in terms of the reaction function to move to cutting. So it wasn't just clarity on the start point, not being March most likely, but clarity on what they're looking for. So it wasn't surprising to me. The reaction by the market was a little surprising.
All right. So, Liz, great to be talking with you again. I'm curious, is there enough enthusiasm out there and fundamentals to keep the equity side of things moving higher? I mean, Fed Chair Jay Powell several times made a point of, hey, guys, this is a good economy. You know, people are working. We've got growth. How do you see it?
Well, I think an environment in which the Fed would start cutting in March, or if there are conditions that suggest they actually do have to cut in March and they go against what they suggested yesterday, I'm not sure that's something you would want to wish for, because it would suggest much more deterioration in the economy, probably specifically in the labor market, which then, pulls into the discussion, the earnings backdrop and the profit margins backdrop. So I think a later start, all else equal, is better. I think we may be in an environment where even on days like yesterday and the indexes get pulled down because you get some of the mega cap leadership waning, I'm focused at least as much on what's happening under the surface of the indexes. I think we could be in an environment somewhat similar to what happened into the lows of October 2022, where you were getting profit taking up the cap spectrum. It was weighing down the indexes, but you were seeing broader participation under the surface. That's in technical terms called the positive divergence. So much like things like jobs reports that come out, I think you have to look under the surface to get the real story. I think you have to look under the surface of these cap-weighted indexes to get the real story. And a continued broadening out, lower correlations, broader dispersion, all else equal, I think, is a better backdrop.
What happens to equities when the Fed actually starts cutting rates, Lizanne? Cutting rates. I'm wondering if it's all priced into the market right now, or if as soon as Jay Powell says at that first meeting, when they're cutting, we see the floodgates open.
Well, there's no typical behavior of the market, depending on what point you're talking about in the cycle. There's a really wide range of outcomes. Once you get to the cutting part, what tends to be a differentiator as to whether you have a better market environment or worse market environment is, number one, the reason why they're moving to cutting and the speed with which they have to cut. Obviously, cutting because they're trying to pull an economy out of recession is very different than if they're cutting with growth hanging in there simply because real rates have gone up in the throes of disinflation. That would be best case scenario. So it's the why, not this definitive. Once they start cutting, it's sort of a universal move higher by the market. History has shown it can vary quite a bit. So I think it's going to be the why. I do think that this is an opposite cycle. It's always been said that the Fed takes the escalator up when they're hiking and the elevator down. I think it's the opposite this time. They clearly took the elevator up with multiple hikes of more than 50 basis points. I think the inclination at this point is to be more escalator-like on the way down.
I love that. What I want to ask you, though, speaking of things being down, though, what's going on with community banks, and in particular, our focus on New York Community Bank Corp. It's down, I think, about 44% in the past 2 days. Concerns about commercial real estate, higher loan loss reserves. KRE is down 2.6% today. Do you think it is likely we will see other regional banks come under some troubles?
Probably, but I think this is more of a simmering problem over time, or a slow motion train wreck, whatever analogy you want to use. It doesn't appear to be something Lehman-esque, like where there's some announcement or some loss that's going to trigger the, implosion of the financial system. We are talking about exposure, obviously, that's much more concentrated in the small and regional banks. In the case of New York Community Bancorp, obviously, you had that elevation once they bought the assets of Signature up to a different regulatory structure, and now they're dealing with the commercial real estate problems. But even within commercial real estate, it's obviously a very broad category, and I think as an analyst, you have to have a fine-tooth comb when you're looking, regional bank to regional bank, small bank to small bank, to see what type of commercial real estate exposure do they have. Is it more office concentrated? Is it in other healthier areas of commercial real estate? And then, of course, what the maturity schedule looks like and the strength and health of the balance sheet. So I don't think you can look at this monolithically, maybe like you could the financial system during the sort of Lehman failure 08 period of time. But that's not to suggest the problems aren't still through the windshield and not in the rearview mirror.
All right. So as you mentioned, opportunities, do exist outside of the mega cap favorites. Having said that, we're uber focused, Lizanne, on it with Apple, Amazon, and Meta getting ready to report. Do you have a general call on some of these Magnificent Seven tech names? Is it still
I don't
important?
have a call on what they're going to report, but the earnings reports are important. The outlooks are important because, the consensus for just Q4 is that the Magnificent Seven will have had more than 50% earnings growth. In fact, if you X out the Magnificent Seven's earnings growth from what's expected for fourth quarter, you go back into negative territory. So it absolutely matters individually for the stocks and in the aggregate. But, I don't have perspective on whether one or both or all three are going to sort of beat numbers. But it's absolutely a big factor.
No. And forgive me. What I meant is in perspective in terms of investors having exposure, and just got about 20 seconds left.
Be careful about that concentration because, many funds can't even own as much as they represent in the indexes. I think there is concentration risk. That doesn't mean don't have exposure, but be mindful of having exposure in other quality segments of even cap-weighted indexes.
All right. Well, so appreciated as always. Lizanne Saunders, she's Chief Investment Strategist at Charles Schwab, joining us on Zoom from Naples, Florida.
This is the Bloomberg Businessweek podcast, available on Apple, Spotify, and anywhere else you get your podcasts. Listen live weekday afternoons from 2 to 5 p.m. Eastern on Bloomberg.com, the iHeartRadio app, TuneIn, and the Bloomberg Business app. You can also watch us live every weekday on YouTube and always on the Bloomberg Terminal.